If you logged on to X or hopped into a financial trading subreddit over the last 48 hours, you have witnessed a full-blown psychological pile-on targeted directly at the largest corporate treasury experiment in human history. The noise reverberating across the retail and short seller landscapes right now is nothing short of apocalyptic. Critics and prominent bears are declaring that the financial house of cards built by Saylor and Strategy, formerly MicroStrategy, is finally in its terminal collapse phase. The panic metrics are being shouted from the rooftops. Look at MSTR trading at a massive per-share discount to its net asset value. Look at the preferred stock ticker STRC tanking to a record low of $87. Look at Bitcoin breaking below the company's average cost basis. Saylor is going to get margin called, forced to liquidate 840,000 Bitcoins, and he'll be trading his orange tie for an orange jumpsuit. Retail traders are reading these headlines and panicking, convinced that a systemic corporate liquidation loop is about to pull the trapdoor on the entire digital asset economy. But the signal, the cold, forensic truth revealed when you actually open the corporate balance sheet, study the debt covenants, and analyze the mechanics of the 2026 Treasury architecture, exposes this panic as complete mathematical illiteracy. Strategy is experiencing a genuine, near-term operational squeeze, but it looks absolutely nothing like the retail liquidation myth. The corporate plumbing is not breaking. It is functioning exactly as it was engineered to do under stress. Today, we deliver a thorough masterclass dismantling the Saylor collapse narrative. We break down the exact reality of the $75,000 cost basis, expose the mechanics behind the preferred stock par value fracture, and deliver the definitive structural verdict on whether this corporate showdown is fundamentally bullish or bearish for the long-term future of Bitcoin. My name is Newell, and welcome back to the Signal and Noise podcast. If it's your first time here, make sure to like and subscribe. Let's dive in. Let's start by injecting hard data directly into the core fear-mongering narrative. The claim that Strategy is on the verge of bankruptcy because Bitcoin is trading below their average purchase price. According to Strategy's definitive SEC 8K filings from earlier this month, the company holds a gargantuan treasury layout of 843,706 Bitcoins. Their aggregate investment cost totals roughly $63.9 billion, yielding a hard average cost basis of $75,699 per coin. With Bitcoin currently fluctuating beneath that boundary, the company is sitting on a multi-billion-dollar paper loss. To the untrained retail speculator, a paper loss equals an immediate margin call. But let's look at how corporate debt is actually structured. The fundamental flaw in the orange jumpsuit thesis is a total misunderstanding of Saylor's debt plumbing. Strategy did not buy its Bitcoin using localized, short-term margin loans from a centralized crypto lender. They raised billions by issuing long-dated senior convertible notes maturing in 2027, 2028, and beyond. Crucially, this debt is entirely unsecured and carries no liquidation price cascades. There are no margin call triggers. No lender has the legal framework to force a liquidation of Strategy's Bitcoin holdings based on short-term spot market volatility. However, the bears found their primary ammunition at the end of May, when Strategy did something it hadn't done since December 2022. They sold 32 Bitcoin for approximately $2.5 million. Mainstream media ran wild, claiming Saylor was capitulating. The signal, however, was explicitly stated in their treasury notes. Strategy issued a unique series of perpetual preferred shares, trading under the ticker STRC, which carry a combined annual dividend obligation of roughly $750 million to $800 million. The 32 Bitcoin sale wasn't a structural panic. It was a programmatic treasury allocation designed to clear a localized preferred dividend distribution. Saylor noted that the model is designed to be a net accumulator, aiming to buy 10 to 20 coins for every single token distributed for operational upkeep. The corporate thesis hasn't broken, but a very real bottleneck has opened up in their capital-raising engine. If the margin call risk is completely fake, what is the actual problem keeping the stock under heavy pressure? The real stress point lies within the premium contraction and the mechanical breakdown of their at-the-market ATM issuance program. Strategy has spent years operating as a high-velocity capital loop. The STRC par fracture. Strategy's primary preferred stock asset, STRC, has experienced a severe correction, slumping down to a record low of $87. This is highly significant because it has fractured well below its $100 par value. When a company's preferred shares drop below par value, it legally and structurally forces a pause on their at-the-market issuance programs. Strategy can no longer easily use this channel to continuously raise programmatic cash to stack more Bitcoin. MSTR's historical multiple over its net asset value has heavily compressed, sitting around 0.97 times. The stock is no longer trading at a premium. It is trading at a slight discount to the spot Bitcoin on its balance sheet. This is the exact point where smart institutional money separates from retail noise. Large capital flows realize they can buy MSTR stock and effectively acquire Bitcoin at a direct discount relative to the spot market. Let's bring it all home to the definitive structural verdict on the Saylor standoff and determine exactly what this means for the macro future of Bitcoin and the broader crypto market. Is this setup fundamentally bullish or bearish? In the near term, it represents a localized bearish drag on momentum, but over a mid to long-term horizon, it is profoundly structural and bullish. The ultimate signal is that the systemic risk has been completely overblown. There is no hidden debt trigger that can force 840,000 Bitcoins onto the market. Strategy has enough sovereign cash runway and underlying assets to absorb a further 50% downside decline. The orange jumpsuit narrative is nothing more than a fiction. Saylor's structure has successfully commoditized Bitcoin onto the balance sheet of an elite public company. The premium is gone, the leverage loop is cooling, but the network throughput remains entirely unbroken. Stay sharp. Stay focused. That's it for this corporate treasury edition of the Signal and Noise podcast. My name is Newell. Make sure to like and subscribe. We'll see you on the next block.